ARM reporting its second fiscal quarter earnings this week for the first time since its IPO, with the disappointing guidance that they've also unveiled. The chip company forecasting its current quarter's earnings per share to be between 21 and 28 cents apiece. That's lower than Wall Street's estimates of 27 cents a share. ARM saying its revenue is vulnerable to macroeconomic headwinds impacting the overall industry, but they expect recovery. Not all bad news. The company announcing its highest ever quarterly revenue, raking in over $800 million. That is up 28% year over year. Some of the other highlights that the company called out here, particularly the immediate need for companies to increase investment in artificial intelligence and AI across all end markets, helped drive license revenue up 106% year over year. This is also a company, of course, that changed its model and how its revenue is going to be driven going forward, where they're picking up the revenue on the per use basis of the chips and what they're designed for, versus waiting for the chip to be embedded within that technology and then picking up the revenue on the other side of that as well.
Yeah, certainly. And taking a look at this release, also just talking about the royalty revenue, saying that they did benefit here from the market share gains in automotive and also in cloud computing, as the latest technologies there, such as R9, really increased penetration across markets, which we know is so critical here for ARM going forward. But I think the reaction, obviously, that we're seeing in the stock today, a lot of that is because of the guidance rather than the results that we just got here for the most recent quarter. We talk about the slowdown that we're seeing here within the mobile market. Obviously, that is going to the smartphone market. That's going to have a real impact on ARM. And then also just some of the uncertainty around the licensing deals going forward, what some of those new deals look like. That's a big question here for analysts. But despite all this and despite that weak guide, it's interesting to me going through some of this analyst commentary here following these results. They're still pretty optimistic. They're defending their bullish outlook here on ARM going forward. Barclays is one of those saying that the fundamentals still show that the story remains intact, and KeyBank also coming out saying that any weakness in royalties is likely to be more than offset by some of the strength that they will see in licensing here going forward, especially going into the second half. So some important things to keep in mind there.
Yeah, hard to say something bad about a company that you were the underwriter for.
Exactly.